Our latest high-conviction research report just went live. It's January 23rd, 2026.
And the focus is vital farms.
And if you're looking at the chart this morning, it is ugly.
Ugly is being kind. It's a bloodbath.
The stock's down about 47% from its highs, sitting right around $28.38.
Yeah.
I mean, the market is just screaming, value trap.
Absolutely. It's being priced for bankruptcy, basically.
Right. But then you look at the financials and see a company that just posted, what was it, 37.2% revenue growth?
Which is just a massive disconnect.
It doesn't make any sense. So our mission here was to figure out why.
And what we found is that the market has put vital farms in the penalty box. This 47% haircut is because for these ethical brands, it's a binary choice.
Perfection or fraud.
Exactly. There's no middle ground in the consumer's mind.
And our research really points to this being a textbook compounder on sale. But first, we have to talk about the noise. Why all the negativity?
It's not the numbers, it's the narrative. Specifically, this whole linoleic acid panic. It effectively just stripped away their premium valuation overnight.
So social media gets a hold of the fact that they use some corn and soy feed supplements.
And suddenly, the pasture-raised label is a lie.
Right.
And this is what we call the purity trap in our report. When your whole brand is ethical, you have to be perfect.
Any small crack and you get punished way harder than the big industrial players who, don't promise anything in the first place.
And it certainly didn't help that insiders were selling stock right as the price was tanking.
That looks terrible. To anyone just casually watching, it looks like the leadership team is jumping ship.
It looked really, really bad. But when we actually pulled the SEC filings, that panic theory just kind of collapses.
Because they weren't market dumps.
Not at all. They were standard Rule 10b-5-1 plans.
So programmatic sales.
Yeah.
Scheduled months in advance.
Exactly. Not some panic reaction to a Twitter storm. And Matt O'Hare, the founder, still holds over 6.3 million shares.
He's not going anywhere.
Not a chance. That selling story is pure noise.
So if the panic is fake, then the opportunity is real. Because this is, at the end of the day, an egg company, a commodity business.
But trust is the key. That's the decommoditizer. You've got that black carton.
It's like a billboard in the dairy aisle, right? That's the brand.
That's the brand block, yeah. But the real moat, the thing we identified as almost impossible for a competitor to copy, is their supply chain.
That decentralized network, all those family farms, what is it, over 575 now?
It's a huge number. And if you're a competitor like a Cal-Maine, you can't just build that.
Oh, wait.
The logistics of managing that many small suppliers, it's a nightmare. That complexity is their defense.
And the financials, they just back it all up. We ran what we call the sanity check.
And the balance sheet is pristine, zero debt.
And what, about $160 million in cash?
Roughly, yeah. Which is how they're funding that huge new facility out in Seymour, Indiana.
All from their own balance sheet. No leverage. I mean, for a growth company, that's incredibly rare.
It really is. So when we put it all together, the market sees some sort of terminal illness because of a few bad headlines.
But our research sees a temporary reputational bruise, that's all, on a company with truly elite financials.
Which brings us to our final verdict.
Our final score.
We scored it an 18.5 out of 20. Very high conviction.
It really just feels like time arbitrage. The market is obsessed with the short-term narrative.
While we're betting on the long-term compounding of the business itself.
Well, I guess we'll leave you with a final thought to mull over.
We talk a lot about trust as a business moat. And in the food industry, it might be the only truly defensible moat left. But it does raise a pretty tough question.
Is that trust resilient enough to survive even a single crack in the narrative?
Or is it actually the most fragile asset on the entire balance sheet? Because unlike a factory, once trust is broken, you can't just rebuild it.
Something to think about. Thanks for joining us for this deep dive into our research. We'll catch you on the next one.